Good day, I am Rika Jean Bima Putol and I am going to tackle about the restaurant accounting system. First, let us know what is an accounting system. Accounting system is a set of accounting processes with integrated procedures and controls. The intent of an accounting system is to record business transactions, summarize those transactions into an aggregated form, and create reports that can be used by decision makers to monitor, analyze, and improve operations. Accounting system is a system implemented by companies to record financial information, including income, expenses, and other accounting transactions. It acts as an important tool that monitors and tracks the company's performance and ensures the smooth running of the business. An accounting system typically includes coverage of the major functional areas of an organization, including the purchase of goods and services, sales of goods or services, payments to employees for wages earned, and financing activities such as obtaining debt, selling shares, and paying interest to lenders. The specific components of an accounting system include accounts payable, billings and accounts receivable, fixed assets, inventory, and payroll. Depending on the volume of transactions being processed, there may be specialized accounting staff assigned to each of the preceding modules. Next, we have the accounting system features. First is reliability. The information produced should be reliable. It is an essential feature. If the data entered in this system is not authentic, the outcome are also not trustworthy, so it will not be possible to properly estimate the company's prospects if it is not reliable. Second, an accounting system should be easy to understand. It should be straightforward to understand where a transaction is hitting precisely and what effect the transaction will have on the financial statements. It should not involve complicated formulas and should be easy to operate. If it is complex, then the accountant handling it may get confused and make errors. Third is comparability. Financial statements produced by one accounting system should be similar to those produced by other accounting systems, resulting in an apple-to-apple comparison. Calculation methodologies should be as per industry standards so that the masses can understand financial statements. Fourth, latest software. This system should be capable of developing itself automatically with the ever-growing financial world. So the latest software which gets updated automatically should be used. Everything is going automated in today's world, so this system should be able to adapt to this. And lastly, an accounting system should be easy to use. Accounting system should be easy to use. It should not be that an employee needs to go through rigorous training to understand the system. The charts and statements should be easy to generate. Once everyone easily understands it, only everyone can bring ideas for upgradation. Next, we have the types of accounting system. There are two types of accounting system. First is the single entry. It is an informal way of maintaining a record of financial transactions. Here, separate accounts are not opened. Only expenses and income as and when a happening are recorded. So it is not possible to prepare charts and other financial statements from the single entry system. Small businesses mostly maintain single entry as they don't have the expertise to follow the latest systems and are not accepted by authorities for tax reporting. Second accounting system is the double entry. It is an accounting system to record a transaction in a minimum of two accounts. It is based on a dual aspect, debit and credit, and this principle requires that for every debit, there must be an equal and opposite credit in any transaction. It is accurate and it is used by all major organizations worldwide. Here, transactions are clubbed into separate accounts, and each transaction has two legs that affect different accounts. So it is easy to find mistakes as every transaction has two legs so that the other leg may be correct and the auditor gets a trigger. How does it work? First, whenever any transaction happens, such as sales, purchase, expense, or any transaction, then that transaction is recorded through proper journals. So this is the first entry that you do in this system. Second, as all the accounting systems are computerized now, the respective entry is the correct accounts ledger is done whenever you post a journal. Third, at the end of the period, it calculates the balance of the ledger and prepares the financial statements like balance sheet, cash flows, and etc. Next, we have the components of an accounting system. First, input devices. These are tools that help in recording the transaction in this system. The primary input devices are keyboards, voice assistants, recorders, barcodes, scanners, and etc. So with the help of the devices mentioned, we enter one transaction in the system. Second is the processor. After inserting the information, the system picks up the data and directs it to the correct ledger, journal, or other charts as required. This activity is called information processing. Third, we have the storage. Once the data is directed to a particular ledger, this system needs to store the data there. So the system will require the help of storage facilities to perform this task. Fourth component is the output. Once the information is sorted and final statements are prepared, this system will require devices that will help output the information. So this process is conducted with the help of a monitor, printer, projector, or other devices. The accounting system helps to record financial transactions systematically. It is required to prepare financial statements which are being used by authorities for tax purposes and investors to make informed decisions. Ratios and charts are easily calculated with the help of a proper system. How a restaurant accounting system works. When someone decides to open a restaurant, particularly for the first time, they're usually driven by a passion for food coupled with a dedication to hospitality. However, while being a good chef and having a winning personality are two key ingredients, those are not the only ones. If a small business fails, it is often during its first year and usually because of bad business decisions and practices. When you start a restaurant, setting up a good accounting system is paramount to giving your business the best possible chance of survival. Developing a restaurant accounting system is similar to setting up an accounting system for any small business, but there are important differences to consider. Restaurants have slim profit margins, so keeping on top of their key performance indicators or KPIs is essential. So how a restaurant accounting system works? Your accounting system will track all the restaurant's financial transactions, prepare reports based on those financial transactions, gather the appropriate information for taxes, and summarize information for you in a format you can understand. Using that information, you can make the financial decisions for your restaurant that will minimize your expenses, maximize your profit, and keep your customers happy. Without a restaurant accounting system, this would all be a jumble and you would not have the information at your disposal to help you make the best decisions. Steps to implement a restaurant accounting system. First is to hire a bookkeeper or accountant. Unless you are an accountant or bookkeeper along with being a chef or restaurant owner, you are going to need some help in order to set up a restaurant accounting system. Even the smallest of coffee shops have to keep financial records so they can file their taxes and make good decisions to keep the business afloat. There is a difference between bookkeeping and accounting. Bookkeeping is the process of recording financial transactions and organizing receipts and other documentation, while accounting, meanwhile, is the practice of analyzing the information supplied by the bookkeeper and developing reports to make the numbers understandable to a non-business oriented person. Another option is to do the bookkeeping yourself and only retain an accountant. It is a plus if you can hire a bookkeeper and accountant familiar with the hospitality industry. Second is to choose accounting software. There are a number of robust restaurant accounting software packages. You want to choose one that is easy to learn and use but that offers strong reporting and financial analysis features. You need to consider software that generates profit and loss or income statements and other financial statements. The software also needs to have inventory management features and it should integrate with payroll software if you do payroll in-house. Other important features are invoicing, accounts receivable, and accounts payable management, employee scheduling, and menu planning to name a few. Restaurant payroll is complicated with different salaries, tips, and varying work schedules. It is often a good idea to outsource your payroll to your accountant or to a payroll service. If you do payroll in-house, you have to choose payroll software. The same is true for tax planning and preparation. Third is to select accounting method. You have some decisions to make that go hand in hand with choosing your accounting software. First, you have to decide if you use single entry or double entry bookkeeping to organize your books. Since the restaurant industry involves holding inventory, double entry bookkeeping is usually advisable. You also have to decide whether to use cash or accrual accounting. Accrual accounting gives you the more accurate financial picture since it records revenues and expenses as soon as transactions occur. Fourth is to choose a point of sale system for cash management. A point of sale is a place where a customer pays for their meal and any other products or services they have purchased in a restaurant. Restaurants need particular features in their POS software like tracking sales. Some POS packages can help with menu preparation and timekeeping for employees. Restaurants also need POS software that has strong inventory management functions both for the front of house and the back office. The software can even assist in preparing payroll. Point of sale systems are systems that enable the business transactions between the client and the company to be completed. POS system is a computerized network that consists of the main computer linked with several checkout terminals and supported by different hardware features starting from barcode scanners and ending with card payment terminals. As businesses have different profiles, they need various point-of-sale systems as well. For example, restaurants, retail businesses, and grocery stores all have their specialties and that is why they need a POS system that meets their specific needs. Fifth is to compile the restaurant's chart of accounts. The chart of accounts is a listing of all the 5 categories of accounts that compose the income statement and the balance sheet. These accounts are assets, liabilities, owner's equity, revenue, and expenses. Money flows in and out of these accounts during the normal course of business. When you either spend money or earn money, you debit and credit these accounts appropriately according to accounting principles. Each of these accounts will have sub-accounts that are industry specific. For instance, a chart of accounts for a restaurant will be different than a chart of accounts for other types of businesses. So here is an example of chart of accounts in a restaurant. The accounts are the following: beverage sales, food sales, other sales, cost of beverage sales, cost of food sales, any discounts that are given that even marginally affect bottom line, rent expense, insurance on building, security or alarm services, janitorial, building repair and maintenance, except for repairs and maintenance expenses, property taxes, utilities, disposal services, officer wages, officer benefits, management wages, management benefits, and employee wages with their categorization. How to track the restaurant's flow of funds. There are specific accounts in a chart of accounts that are particularly important for restaurants. Keep a close eye on the following. First, we have the payroll. Perhaps the most problematic account in restaurants is payroll. Restaurant workers may be both full-time and part-time workers at different rates of pay. It is advisable to either outsource your payroll services or at least use specific payroll software for this task. Second is inventory. In a restaurant, your inventory will consist of 2 broad classes. We have the food and supplies. Track your inventory so you won't have too much, which will end up as waste, or too little, which will hurt your sales. You want to keep your average daily inventory as low as possible without causing shortages. Your POS software is invaluable in helping you keep track of your inventory. Third, we have the accounts payable. Accounts payable is what you owe your suppliers and is listed on your balance sheet. When you receive an invoice, input it in your accounting software. In this way, you won't be late paying your bills. A good relationship with your suppliers and vendors will help your business run smoothly. Next, we have the cash flow. Keep track of how much cash goes into and out of your business. It's helpful to know your cash flow on a daily, weekly, monthly, and quarterly basis. Developing both a cash budget and a statement of cash flows will help you track your cash flow. Fifth, we have the sales. It is important for a restaurant owner to know how much of your sales come from food and how much from beverages. You can further break this down into eat-in meals, carry-out meals, and even into different menu items by using your accounting software. Last is the cost of goods sold. Cost of goods sold in a restaurant consists of all the food and supplies used to make the items on your menu. You should distinguish cost of goods sold from the other costs of running a business, such as rent and utilities or occupancy cost. The chart of accounts for a restaurant lists all occupancy costs as expenses, while food and supplies are listed under cost of goods sold. Important reports for restaurant accounting. First, we have the daily sales report. There are reports that are specific to restaurant accounting and other reports that all small businesses should maintain for both taxes and the purpose of accountability. The restaurant-specific reports delineate your KPIs. These reports can usually be generated by the restaurant accounting software and the POS software. First, we have the daily sales report. This report allows you to compare your week-to-week or month-to-month sales in order to see how your restaurant is doing before deducting expenses. Second, food costs. You need to see how much food is costing as compared to the total revenue brought in by the sale of food items. Your POS system provides these figures. Next, we have the occupancy cost. These costs, like rent and utilities, are your overhead and don't change much. Prime cost. This report compares your labor cost plus cost of goods sold to your revenue. Usually, labor costs, which include payroll along with employee benefits, make up approximately 30% of revenue. The prime cost in a restaurant constitutes most of your expenses. Keep a close eye on prime cost because it is where you can save the most money. Lastly, we have the operating expenses. These expenses are everything not covered by prime cost and occupancy expenses, like for example, marketing and advertising expenses. These are the reports that every small business should maintain. First, we have the income statement. The income statement is your profit and loss statement. It will show your expenses over a period of time like a month or a quarter. The income statement lists your revenue as compared to your expenses. Second, we have the balance sheet. The balance sheet shows what the firm owns or the assets and what it owes or its liabilities, as well as the owner's equity. If you owe more than you own, you should take steps to increase your revenue and reduce your debt load. Next, we have the statement of cash flows. The statement of cash flows shows the inflows and outflows of the cash within your firm. It is an invaluable tool to keep track of your cash needs. Objectives of restaurant accounting system. First is to enhance the utilization of resources in an efficient manner. Second is to equip with efficacious internal control system and procedures in order to protect the assets of the restaurant. Third, to secure accurate and convenient acquisition of financial information. Fourth is to provide management with essential and relevant information for adequacy of financial reports in an efficient manner, to determine the capability of its operations from such management and financial reports. Accounting plays a vital role in restaurant as it gathers, communicates, and interprets the different historical data and forecasted economic data, which is useful in determination of the financial position and possible results in the operations of the restaurant. Several transactions involved in the operations of the restaurant derive from the source documents of the Book of Accounts. The following are the underlying general principles which comprises the basic features included in the accounting system. First is the accountability for the completion of duty. Second, automatic check with large number of functions, in which no one should have complete control over a business transaction in order to guarantee that Errors committed will be discovered by others who are processing the same transaction. Third is the test of accuracy in order to guarantee an accurate accounting data compiled. Fourth is the segregation of tasks or duties. Lastly is the record-keeping accuracy in order to maintain integrity. We have here the accounting system in restaurant operations. Effective accounting for restaurants is one of the most important aspects of making a business successful. Since the profit margins in restaurants are slim, it is important to keep a watchful eye on the bookkeeping process. In the transaction processing of a restaurant, it starts in the arrival of guest or customer. Second is to ask the guest if he or she has a reservation in the restaurant. If the guest answers yes, then the personnel in the front desk will take the guest to the reserved table. If the guest answers no, the front desk personnel will check for available tables and then take the guest to the table. The waiter will introduce the menu and take the order of the guest. Next, the waiter will bring the orders to the counter and the kitchen will prepare the order or orders. Then the waiter will serve wine or drinks, starters, main course, and desserts. After serving, the waiter will go to the cashier with the order list of the guest. The cashier prepares the bill and the waiter will bring the check to the table. The guest will close the check at cashier's area. The cashier inputs the orders of the customer to the POS system and collects payment afterwards. If the bill is not paid, the restaurant can send unpaid bill to the collection agency or to third-party person to collect it. Next is to deal with the collection agency. In dealing with collection agency after the restaurant send the debt to collection agency, the customer is obliged to contract with the collection agency for payment agreements. If the bill is paid, then it is now the process of receiving the payment. In the payment received phase, the restaurant receives the payment and reviews the billing compliance after. In reviewing the billing compliance, accurate compliance of billing is significant because any inaccurate billing might lead to serious financial problem in the restaurant. Also, accurate billing is helpful in making important business decisions, which includes improving services and ensuring financial stability of the restaurant. That is why it is necessary to review the billing compliance of the customers to assure accuracy. The next is to record payment. In recording the payment, once the billing compliance of the customer is completed after it has been reviewed, then the restaurant will record the payment. Next is to recognize revenue. Once the payment from the customer has been recorded, then the restaurant will now recognize revenue from the food items bought by the customer. Next is revenue input. In revenue input, the revenue input will help the restaurant for better decision making, specifically in the revenue projections. Next is the tax audit. Receipts and bills must be double-checked and bills must be verified with attached receipt book, receipt counter pool, and cash book. Verification of bill in arrears is required to be done. Therefore, taxes based on the revenue from the food items sold in the restaurant. Tax audit is done to come up with accurate amount of tax to be paid. Audit is necessary to ensure correctness and compliance of restaurant in accordance with law, rules, and regulations. The last process is revenue evaluation. As the rough examination of the revenue cycle can significantly reduce the number of insurance claim denials in practice resulting in enhanced cash flow and overall practice of the restaurant, which indeed helpful in the business maximization of profitability. Next, we have the accounting system in purchasing. Purchasing involves the purchasing agent, who is the person in charge of purchasing. So regardless of his other responsibilities, he should have to purchase all supplies, resources, and equipment needed in the restaurant. The storekeeper and receiving clerk should make reports to this person in possession of the receipts for goods purchased. First step is the needs identification. In this phase, you have to identify first what are the needs. This phase enables restaurant to sketch up an accurate plan for purchasing in a timely and cost-effective manner. Second is purchase requisition. In purchase requisition, it contains necessary information required to obtain the appropriate materials or supplies to be purchased. Third is request examination. It is necessary to examine the request in order to know if the requested items are really needed and to double-check if the available funds are sufficient. Fourth is the budget approval. After the request has been examined, then the budget should be approved. Once the budget is approved, the purchasing agent sends out a request for quotation or RFQ to suppliers with the goal of receiving and comparing bids to find the best supplier. Then fifth is supplier selection. In this phase, it is necessary to look for the best supplier among others and to conduct an evaluation before having a contract. The primary goal of supplier selection process is to lower the purchasing risk and increase total value to the purchaser and foster closeness with the supplier. Next is negotiation and contract. In negotiation and contract, once the supplier has been chosen, the contract is negotiated thereof and the purchase order is sent to the supplier. When the supplier accepts and acknowledges the purchase order, a legal contract is formed. Next is receiving orders. In receiving orders, once the supplier meets the deadline and provides the promised items or after receiving them, the purchasing agent inspects the items and informs the supplier if there are any problems with the products being received. Next is receive and check invoice. When the invoice has been received, it is necessary to review or examine it to assure accuracy and to minimize the potential risks. Next is invoice approval payment. In this process, once the order is received completely with an accurate amount of bill, the invoice is approved and forwarded to payment processing. Next is the record keeping. Every event in the purchasing process must be recorded. This is important to maintain an audit trail of the requirement from the initial receipt of the purchase requisition to the closing out of the contract. Last is purchase order closure. In purchase order closure, once the items ordered are completely delivered by supplier or received by the purchasing agent, the purchase order will be closed immediately. Next, we have the detailed policies, systems, and procedures. The restaurant will follow the generally accepted accounting principles or GAAP. First, we have the principle of regularity. The principle of regularity states that accountants will strictly follow the standards and regulations of GAAP accounting. Second, principle of consistency, which states that accountants will apply standards consistently throughout the process of reporting, both in each report and throughout multiple years of reporting, rather than choosing when to follow or diverge from GAAP. Third is the principle of sincerity. which states that accountants will be impartial and accurate when reporting the company's finances. Fourth is the principle of permanence of methods. The principle of permanence of methods is an additional commitment to regularity and consistency, emphasizing the need for reports to be comparable between different companies and fields. Fifth, principle of non-compensation, which states that accountants should commit to full disclosure of the facts, both good and bad, surrounding their institution's finances and cash flow. Next, we have the principle of prudence. The principle of prudence states that accountants will stick to a conservative, fact-based approach to financial results rather than indulging in speculation or opinionated judgments. Seventh is the principle of continuity. The principle of continuity states that accountants operate under the assumption that the institution will continue to operate under its current practices, which has a major effect on the value of its assets. Eighth is the principle of periodicity. The principle of periodicity states that accountants will commit to regular reporting according to a predetermined period, usually a set fiscal year or fiscal quarter system. Ninth is the principle of materiality. The principle of materiality states that accountants will commit to full disclosure rather than obscuring certain facts or leaving information out of their reports. And lastly is the principle of obiterme fidei, or the utmost good faith. The principle of utmost good faith, from the Latin obiterme fidei, states that in financial reporting, all parties should assume that the other parties are acting honestly. The restaurant will use accrual accounting, which means that income and expenses are recognized when they happen rather than when money changes hands. Accrual accounting is a financial accounting method that allows a company to record revenue before receiving payment for goods or services sold, or expenses are recorded as incurred before the company has paid for them. In other words, the revenue earned is recognized on the company's accounting books regardless of when cash transactions have occurred. Accrual accounting generally makes the relationships between revenue and expenses clearer, providing better insight into profitability. It also offers a more accurate picture of a company's assets and liabilities on its balance sheet. This method smooths out the restaurant earnings over time by accounting for all of the expenses and revenues as they are generated. And that would be all. Thank you and God bless.